Look forward to the next one. For the time being, let's move on and welcome our next guest on the show. Vinay Jaising, JM Financial Services, is with us. Vinay, great to have you on as usual. You know, we're just looking at the news that's coming in. It's from sources right now about, potentially additional subsidy being offered on the Ujjwala scheme. It flows in with the narrative on the kind of steps that the government is taking, whether it's rice, whether it's onions, the Prime Minister's speech on Independence Day with respect to housing for the urban poor. So what's the sense? Is the government getting in full election mode? And if yes, could that be a short-term risk for the market, or is it baked in?
So, food inflation has created a sense of pain for the economic part of the business for the country. We have seen 7.4% as the CPI inflation. Having said that, the subsidy of LPG, which is, going to be increased, or a discount given to the customer, only comes from the government books, doesn't come for OMC to be paid. So we need to keep that in mind. Also, if you look at oil prices, yes, in the short term, oil prices have moved from 70 to 80. But if you look at it over a year and change, oil prices have actually moved down from 100 to 80. And we are consuming about 45-50% of our net imports from Russia, which is probably at $70 to $75 per. So I think the OMCs are or have made in the last quarter or two disproportionate amount of marketing margins. And now they're coming back to normalcy. So I would tend to believe that, yes, the government is looking at food inflation and they're trying to curb it by first, increasing availability of food crops for the country, and B, reducing the prices of, energy products for the country. I will not be surprised if they cut petrol and diesel prices as far as the excise duty is concerned as well. I don't think this is totally linked to politics, but yes, in the next 12 months, you have election. But, if you see what's happening in the world, inflation, even in US, the world wants to get it down to 2% for US. So why not get it down to the RBI standard of 4 to 6%? So I think the government is doing the right thing to try and curb inflation.
Vinay, afternoon. You're underweight on agro and specialty chemicals. The earnings have been weak, but is there a tactical play, maybe for the next 3 months, 6 months? Do you think these stocks could do well? Because prices may have bottomed out and there could be a little bit of an alpha which can be generated.
Absolutely. Just to correct you, we are actually overweight on specialty chemical space. And the reason is exactly which you just gave. Which is, technically what's happening is, China is close to a bottom. As far as inventory levels are concerned, they've risen, the prices are down. So as you start seeing prices move up a little bit, you'll start seeing a lot of, better numbers to come ahead, be it companies like Tatva Chintan or be it companies like Archean. You're seeing the worst behind you. You're seeing a better price. All you need is volume growth. And I think these stocks, which are relatively much cheaper than what they were, Archean trades at about 10, 11 times 1 year forward. It's had a beautiful run in the short term. Tatva 2 is corrected by almost 35-40% from its peak. So it's at about 21, 22 times 1 year forward. They're both tomorrow's stories for, the bromine chain, which is fire retardants, and then, EV in the future. So I think, yes, these are places where one can buy in today's atmosphere where the market looks at 5-year average multiples of 20.
Vinay, hi, afternoon. You own Bharat Dynamics, BEL, MTAR Tech. I was wondering not about why you own these, but why have you looked at HAL, by the way? I mean, that's the only one in the aerospace side of things.
That was the first stock we owned.
Sorry, what is that?
That was the first stock we owned in the defense name a couple of quarters ago. We still own it, and wonderful story. It's a make in India story. We like it. The problem in defense is the problem of high quality of plenty, be it Hindustan Aeronautics, be it Bharat Dynamics, be it Bharat Electronics, or be it MTAR. All of them have a huge growth. Since you mentioned Hindustan Aeronautics, obviously the Tejas angle, it's one of the only companies in defense which has just 1% coming in from exports. So the Make in India or the China Plus One story, when Tejas starts getting sold to the rest of the world, is not even evolved. 2 years forward, the growth, which is currently probably at 10% levels for Hindustan Aeronautics, will grow by more than 50%. It'll go to 15% plus. In terms of valuation, they are at somewhere close to 25 times F25 numbers, and then you're seeing the earnings trajectory pump up, return on capital employed is good. So we like the defense space and all. It's a problem of plenty.
And it's wonderful enough to even get in now for some of these names. Valuation, how would you value them? You'd value them at where global peers trade. You'd value them as capital good companies.
So that's an interesting question you ask. So when we look at valuation, they're more or less trading at where global peers are trading, which is 25 to 30 times for 1 year forward. Having said that, their order book for all the defense companies are far more than the order books for, the global names. Start with Hindustan Aeronautics. There the order book is 7 to 8 times. You look at Bharat Dynamics and Bharat Electronics, they're 6 to 7 times. Bharat Dynamics and Bharat Electronics earnings trajectory is not 10 to 15, but it's somewhere between 30 and 45% respectively. So you're seeing good earnings trajectory come back here. There were some supply constraints because of which Bharat Dynamics couldn't grow as fast in the last quarter, which just means the next quarter you would start having further earnings growth for them. So if the earnings momentum is good and it's north of 25 to 30%, and the exports, let's say for Bharat Dynamics, is going to grow from 7-8 to 15 in the medium term, and then 20 to 25% in the next 5 years. I think these are companies wherein you can even use a PEG ratio and start looking at the earnings growth for these companies, giving you returns for the company.
All right. Hi, Vinay. Let's talk about the auto space. One such stock in there, Tata Motors DVR, you're waiting for some kind of a corporate action to come about, and that did finally come about. But from then on, Tata Motors DVR has cooled down a little bit. Your view on this stock, because in the next few months that corporate action does play out. I think within 18 months or so.
That's right. So we like Tata Motors. The story of Tata Motors, which is firstly globally they have turned around. The Jaguar story. You're seeing them report free cash flows from there. They would be net debt negative, which means cash positive for their global asset, which was the biggest reason why people were negative Tata Motors. You've got Tata Technology listing coming in as well in the future. On an overall basis, Tata Motors, both domestically and globally, if you look at just their EV EBITDA, on a consolidated basis, they are under 5 times. Most of the domestic comps overall are trading at 9 to 10 times EV EBITDA. So the stock has done well, but there is a big catch-up impact compared to the other peers. Having said that, important is Tata DVR even today is giving you between 6 to 7% discount to buy Tata Motors as a stock. So, with an 18-month perspective, you're getting a cheaper Tata Motors, so why not buy it? We like both, but we like Tata Motors DVR better.
Oh, okay. All right. Still that differential with the regular listed stock, right? So looking to perhaps play that. Thank you, Vinay. Good talking to you today. Thanks very much for your time, and we look forward to the next connect. On that note, we have to take a quick break.